Hey, welcome back. Here is episode 2 of the portfolio updates, and even if I didn't buy that much, a lot of things happened, so let's get into it. To begin with the portfolio itself, I only bought a bit of Coolco as mentioned in the previous video and eToro price for a bit more stability and dividends. The dividends were very tiny, like 0.1%, and basically all of that went into the two positions. Due to the environment, I'm currently holding on to the cash and there are quite a few potential buys, including some new positions, but more about that in a bit. The Fed decided to keep the rates unchanged due to economic uncertainty, especially due to the tariffs. That obviously has a negative effect on everything, especially my dividend stocks, but at least it may open some buying opportunities. What could significantly make the market crash is not just pausing the cuts but actually increasing the rates, which nobody expects and would definitely shake the market. You know, with tariffs and Trump even saying recently that he doesn't care if auto producers increase the prices, which could be one of many factors that would cause inflation which the Fed has to fight, anything can happen. I waited a bit so that I can mention Trump's new global tariffs in this video while they are fresh. The market really didn't like it, and tech and especially companies that depended a lot on supply chains in China and Vietnam for example were hit very hard, even in the double-digit levels. Now I think that trying to nationalize everything is simply bad. Besides being against a smart modern economic theory, you simply can't or shouldn't even want to have everything made in your country. Why would you want to deplete your own natural reserves of iron, for example, when you can get it for probably cheaper and in better quality from Brazil? I get semiconductors and vital things, but not everything from everyone. I think it's very likely to see some retaliation from other countries, which can degenerate into even worse, but more about this later in the video. I don't want to talk about this too much now. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. What I told people on Patreon earlier is that I really recommend having an emergency fund just in case you'll have to buy cheaper stocks or maybe groceries become more expensive. Another update that the market didn't like that much is Google buying Wiz for a massive 32 billion all in cash. This is the company's largest acquisition ever and would improve their cloud security. It's currently pending regulatory agreements and it should be ready in 2026. It has potential to allow Google Cloud to develop and compete with Microsoft and AWS, and if anything, if one of those two bought it, Google might have been significantly behind. But they also paid like 3x what the company was valued in the last founding round back in 2023, so that's quite a bit. I didn't buy that much, but on the bright side, a bunch of companies are getting very close to a potential entry level or developing, such as Nike, so I'm looking forward to better prices. As a note here, I'm keeping the money in interest-bearing accounts paying me like 2.5–3% interest per year. We see China continuing to go up, with Alibaba almost doubling since I made the analysis and thankfully bought some more in January. The companies kept having some AI models and other news, but I think it's more about the long-awaited change in sentiment combined and helped by government support. For Alibaba in particular, as I said, I think it was a matter of many things combined. You had no more selling pressure from SoftBank, which was huge, direct government support and more stimulus, hype around AI, weakening dollar, politics and more, all basically at the same time. I think the main lesson here is to always remember that stocks are also about supply and demand, especially in the short term. Have a catalyst and back it with good fundamentals and a clearly undervalued company and we see what can happen. But I still think there is money to be made in this type of company, especially in the long term. Also worth mentioning is gold reaching 3,000 per ounce, breaking all-time records. I'm working on a long gold miners video that should be out pretty soon if it isn't already. It's kind of an expectable result of all the uncertainty, trade wars, actual wars, weakening dollar, politics and so on, and we still have rate cuts in the future. And something that people may not realize is that gold outperformed the S&P more than twice since the beginning of the century. This boring commodity basically went up above all the hype, although 25 years ago we were at the peak of the dot-com bubble. It doesn't mean it will keep doing it, but it's more about what you should be focusing on instead of chasing hype. And as a note, I'm not calling gold by itself a good investment. It's just that the current environment has been and is very favorable for such a commodity, especially thanks to Trump and all the uncertainty. I think given the nature of gold, there is potential to see even higher prices for longer. Now, as I mentioned as upcoming in recent videos, Intel has now appointed a new CEO and there are also some more TSMC rumors. I see that he plans some big changes and the market actually liked it quite a bit. He allegedly wants to focus on foundry and AI chips while cutting down some management, which I believe is the right thing to do, so they seem to be on the right track. Again, they have the fundamentals to support it and a good CEO change was a key catalyst in my opinion. Now, I guess it's time to enjoy it. It won't be easy and it's not the end of the story, but something to remember is the importance of the fundamentals. I mentioned more in the analysis posted recently, but simply put, this company with massive long-term potential if the management did the right things was trading even at a price-to-book ratio below 1. So, by paying a bit above the value of the physical assets, not including the know-how and tech, you could have, if accepted, bought the market leader in almost everything they operate in thanks to the volumes. Adecco Agro and Tether also continued the discussions where Tether wants to increase the stake from 20 to over 50% and actually agreed to it recently. The company actually reported earnings with everything being pretty good. The cash flow dropped in half, but the expansion capex also nearly doubled, explaining a majority of the difference. The adjusted net income went up around 32%, but the per share level was up nearly 40% thanks to the buybacks. The dividends and buybacks are based on the NCFO by the way, so they should be a bit lower this year if they want to stick to the minimum. I'm not sure how many of you care about it, so I don't want to go too much into detail, but it's my number one position. Now, also very important are the tariffs finally taking effect. In my opinion, general or reciprocal tariffs should be something that stayed in the previous century. I get targeted tariffs like the ones that the EU imposed on Chinese EVs to help the local companies, but general tariffs are one of the worst things you can do to your people in this environment. I said it before, you know it's not China or whatever that has to pay this. Especially when you put tariffs on things like copper or iron from Brazil, which supplies a significant amount to the US, it's your own people that have to pay it. Clothing and stuff is one thing, but playing with vital commodities that you literally can't replace is very risky. I said long ago in the Adecco Agro video that even from a food point of view, America relies way too much on corn thanks to lobbying and subsidies instead of actual food. So I don't think the country is really ready to be isolated from global trade. My guess is, and I hope, this was more of a plan to either basically force companies to invest locally and get exemptions, or something that would give the US an advantage in future trade deal negotiations. You know, we saw car companies, including Stellantis, talk with Trump literally from day one and even get a 1-month exemption initially. It can work in their favor, but it's also kind of a gamble with people's lives after all. Also, as a response, we saw the price of oil drop to, I think, even the level before the war in Ukraine, which is very significant. The market right now seems to fear that this could potentially lead to a recession, at least in the US. That's now especially worrisome after a report from the Fed of Atlanta expecting an even more significant GDP contraction in March. This led to 3 rate cuts being expected this year, which is a tool that the US still has. Maybe forcing the Fed to cut is also a goal, and Trump planned lower oil prices from the beginning, but I don't think this is what he meant. So far he's been amazing for my non-American positions while the S&P fell, but who knows. I mean, like him or not, I don't care about politics, but logically, it's very likely that he has a plan, especially with the Ukraine deal and stuff. And this is why I don't like this hyper-fixation on the extremely short term that's defining the market. You know, maybe it was better back in the 80s or 90s when information was actually digested for much longer before you could instantly buy or sell. I get it for trading, but from an investing point of view, we should be very happy to see pessimism and fear in the market. Even that fear and greed indicator is at like 20 now, meaning extreme fear. China also did pretty good initially, with Alibaba being up like 8% in a day back in early March when the tariffs hit once again. And to be fair, China started dominating the US in several aspects, so if you don't recall the production and stuff, things are going on a very clear trajectory, although long term it's probably the same even with his efforts. As I'm recording this, I outperformed the S&P by more than 10 percentage points over the last month, but you'll see the final result on the screen. But I want to mention again that I don't really care that much about such short-term changes. I had months or even years where the opposite happened. The portfolio is kind of made to benefit from a weaker dollar, and it's doing just that. You know, commodities, foreign stocks, but I also think I was kind of lucky to have Trump do what he does. What I think I'll do in the near future, however, is focus on getting solid US businesses, on top of whatever opportunity I can find, especially in oil and other commodities. You know, stuff like Alphabet, maybe Amazon, Realty Income, maybe some Nike, because it's very likely to see them survive and even thrive in such a scenario, while the prices may offer an opportunity. Again, rate cuts should also be great for the portfolio, so this year might turn out to be one of the best ever, but it's way too unpredictable to say now. I remember this graph from JP Morgan's Guide to the Markets. It shows how many years of outperformance the US had versus others. The rise of the S&P has been fueled by pretty much a lot of hype around Tesla, Nvidia, AI and so on, and that's what happens when the weight in the index is based on the market cap, which I think is a terrible idea. Basically, the more expensive a stock is, the more you buy when you get the index, because the market cap is not always reflecting the real value of a company. It's pretty much made to create bubbles and ignore the undervalued ones. I feel like we take it for granted that the US has the best stock market, but if you look at oil companies for example, they have the most rigid companies, barely investing in their future and even 2 times more expensive than even Europe. And if you look at Petrobras in Brazil, who makes the same as Exxon and pays a double-digit dividend, it's unreal how cheap it can be. We see, especially now, how much politics can influence the market. And with rate cuts, expect an even weaker dollar, which could be good for any stock, but especially foreign commodity producers. Another big company in my portfolio that I've actually partially sold recently, Pampa Energia, also reported earnings. It was a solid quarter and year overall, but the market didn't really react. I'm looking into selling the rest of the position, but I have to say this has been one of my best investments ever, making around an 8 to even 10x in about 4 or 5 years. I think it's a perfect example of a value, commodity and emerging market company. It was also a play around politics in Argentina and reinforces what I just said. The potential of this kind of company, especially in Brazil now I think, is really something very impressive. But obviously there is risk, so don't jump in just because I do. So another interesting month full of developments and even more to come from the looks of it. I'll generally be cautious now and maybe buy here and there. Again, my focus is the long term and presidents, tariffs, uncertainty and so on come and go, but usually also offering some opportunities. Again, have some funds on the side because we might need it one way or another. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.